And we're live. Happy Wednesday, everyone, and welcome to the Mojo Show, your real estate podcast where we talk about everything real estate. I'm your host, Joe Mortgage.
And I'm Cup of Joe Mortgage.
This week's episode, we are tackling one of the most common questions we get from home buyers. Should I get an FHA loan or a conventional loan? Today, we're going to break down the key differences, the pros and cons, and which might be the best fit for you. A lot of material to cover today. I hope we are able to get it all in for you. But before we get to all of that, as usual, a little coffee talk with the Joes this morning. So, Joe, I got a list of questions here actually for you. I know you weren't prepared for this, but
let's see coffee talk. You already got the topics for today, Joe. I know what those questions are, but now coffee talk. Woo! All right, get in the hot seat. Let's go.
You ready?
Yes, sir.
All right. They won't be too difficult. Trust me. So, all right. So which do you prefer, Coke or Pepsi?
God.
Don't tell me either. Neither.
Honestly, it kind of does go both ways. But if my go-to would be Coke, Diet Coke.
Diet Coke.
Yeah.
Okay.
Or Coke Zero. One of those two. I try to stay away from all the sugar.
Okay. All right. Makes sense. How about iPhones or Android?
iPhones, not even question.
I'm surprised we haven't gotten some comments already on that one from people viewing in.
I don't know if I'm smart enough for Android, and I've gotten so used to the iPhones. That's the only one I've ever had, so I'm not going to try to change.
How about this? When it comes to trucks, Ford or Chevy?
Ford.
Okay.
Ford, right. The F-150s, the F-250s, those are my favorites. So I've owned both. I've owned F-150s, 2 of them. I've owned F-250s, 2 of them. My wife is a Chevy person or a GMC. I just, for some reason, the Fords are something that I like over Dodge also, because I've had a Dodge truck, but I really enjoy the Fords, And I understand, found on the road dead, whatever you want to say. All trucks are found on the road dead at some point in their lifetime.
Good stuff, Joe.
What about you? Let's go with your, same questions back. So,
got to be Coke, definitely. Okay. Got to have the Coke. Carrie, my wife, she loves the Pepsi. So, but I'm not a big pop drinker, right? Wait a minute. Would you guys call it pop or soda down here? Or what?
Coke.
Or Coke. You all call it Coke, right?
Coke, Dr. Pepper, Sprite. Like if you go to a restaurant and you order a Coke, they most of the time say, what kind do you want? Or you order Dr. Pepper. Do you have Dr. Pepper? Soda, pop, that's all Midwest and North. That's not a Texas thing. Texas is Coke.
All right. I have to go with the iPhone. It's all I've ever known. And I know there's a lot of controversy between the two, Android and iPhone, but I got to go with the iPhone. Actually, as far as trucks, I would go with the Dodge personally.
Okay. My brother's actually thinking of going with Dodge. He likes the Dodge truck. Dodge has got a lot of nice qualities. I just, I don't know what it is. I like Fords. I think they're easier to work on for me.
I get it.
Dodge guy. Now, the question is, are you going with the 5.7 or the 6.2
Hemi? Do I want to stop at every gas station to refill up or not? Let me think a minute. If I have the ability financially, yeah, I'd go with the Hemi. Absolutely.
Yeah. There you go. Well, it's awesome. I learned something about you, a Dodge man. I like that.
Well, at least for trucks.
Yeah.
So, well, Joe, just like those choices, FHA and conventional, it really isn't about one being good or one being bad. It's about really which one is the best fit for you.
Yep. Yeah. The fitting your lifestyle on these two, makes a lot of sense. Your budgeting makes sense. Credit makes sense between the two. Loan to value, which is the equity you have in your house. I'm really excited about this topic today. I know I turned off the ticker, but everybody, please, feel free to drop your questions or your comments. We want to hear from you. We will share it. We will discuss it. And Joe, I do have to say this. I know we're kind of transitioning, but I'm glad to be back on StreamYard.
Compared to the other software we were trying to use.
Yeah, this one's just more comfortable, and so I'm glad to be back here. I'm glad we have our tickers back and things like that. So, please drop your comments, please drop your questions as we're going through this today. But Joe, let's start with FHA loan basics.
Okay.
So, kind of what are some of the basics about FHA, and what does FHA stand for our viewers?
Well, a lot of people, for some reason, think that it stands for first-time home buyer, which it does not. It actually stands for Federal Housing Administration. So the big key to this, I think at least, is the more flexible credit score requirements that FHA has. Right? I know that for some lenders, for us, we can go down below 580 for a credit score. It's very difficult. I will say it's difficult to get it approved, and you need more than the minimum down payment of 3.5% for FHA. But in some cases, yeah, it's possible, right? So credit scores, I think, is a good key factor with FHA that makes it desirable for some people. Yeah. What about you?
I mean, I agree with you. FHA, the risk factors when it comes to not putting 20% down and having mortgage insurance, it's a lot more favorable now than it was 3 years ago when the factor was higher. They've dropped it down. They are making it more competitive. With it, and because of the backing of the government, it doesn't back the whole loan. There's certain percentages it covers. It helps people qualify with a little bit better interest rate, and with that new mortgage private mortgage factor, because it is regulated, it's all the same for no matter where your credit score's at. So I like that one when it comes to that. But the other reason I really like FHA is, let's say that you're in a situation to where you have been at a job and you get a base salary, but you also get commission income, but you haven't been there for 2 years, haven't even been at the current job for 1 year, but you have this income that can't be used. We can go with a little bit higher debt to income ratio. And the reason I say that is because if we're not able to use other income, I'm comfortable with going up to like a 55, 56% back end debt to income ratio, knowing that you have other income that's not included in your loan approval.
Right.
So that's what I like about that. The reason I say it the way I did, I don't like putting somebody that is on a fixed income or a salary doesn't get anything else in there, and I'm maxing that out at that high debt to income ratio, because then I may be doing the wrong thing for you. But it does have that ability to take you up.
Yeah, I agree. Yep. And you and I have both definitely come across different situations where people are definitely qualified for a conventional loan, which we'll get into some of the basics of conventional here in a moment. But just because the debt to income ratio, they're better qualified for the FHA, right? Because of the higher debt to income ratio that FHA allows. More flexible with.
I do like that. I like, it gives you ability to maybe make a stronger offer. Let's say that you're only qualified, with a conventional loan, it has to be at 50% or lower. They like 45 or lower. And we'll get into that more. I know I'm kind of skipping forward a little, but it gives you a little bit more purchase power. So if you needed to go up another 10,000 or 15,000, you can go up a little bit more than you could if you were going on a conventional route. So that helps your buying power. That's what I like about it, a lot. But, there is a negative to it that people don't always understand, is your purchase price and your base loan amount is not what you're, after that 3.5% down, your loan amount is going to be higher. And that's because we have an upfront mortgage insurance on there. And that's why they don't have, based on credit risk, because everybody pays that upfront, which is 1.75 of your loan amount that's added back on. So your base loan amount, if it's $100,000, another $1,750, if I'm doing the math correctly there, Joe, you can fact check me, is added to that loan amount. So if your loan amount's $100,000 base, we add that 175. So then your true loan amount's 101,750, which is what your payment is based off of.
And thankfully, they make it to where you can add that to your loan amount, right? Instead of coming to closing with it.
Yep.
Right. With that additional fee, so to speak. So,
yeah. And that's where, we talked about APR in previous shows and the differences, right?
Mhm.
That's where, like, you'll see on an FHA loan, your APR is going to be higher because that is being factored into the loan amount and your payment. So it does show that APR is going to be higher for you, but your interest rate is still truly what your payment is calculated on.
Right. And you brought up a good point earlier as far as PMI, right? Mortgage insurance, private mortgage insurance, but PMI on FHA loans, depending upon where you are with your credit score, your PMI could very well be cheaper with an FHA than a conventional.
Yep. It's very likely, if you have a credit score under 700, and I know I'm putting some numbers out there, but if you have a credit score under 700, sometimes 720, FHA's mortgage insurance, if you're only putting the minimum down 3% or 5% or 3.5% on an FHA, your mortgage insurance more than likely will be cheaper than a conventional loan. So, and and the reason for it, and we'll probably talk about that too, is it's credit based when it comes to private mortgage insurance on conventional deals.
Absolutely. So let's jump into a little bit about conventional. We've been talking about FHA. How about some basics about the conventional loan?
So, the first basic about it is there's two different companies that are the backers of conventional financing, and that's Freddie Mac and Fannie Mae. So one of the things, if you ever hear somebody say, we're doing an automated desktop underwriting, or, what does LP mean? It stand for? Can you remember? Loan processing something? I don't know. I'll have to look that up. So I just went blank on it. But there's two different types of automated underwriting systems that they use. So you'll look it up for me. That's the first thing is, you have two different companies, but those are privately, or, right now they're still government backed, but they're not truly government backed loans. The companies have some financing and federal things that are associated with it.
Loan prospector.
I knew I was close. I said loan processing. So loan prospector. That's one of the things. Your other things on conventional basics for a first-time home buyer, to get the 3% down, there has to be somebody that's first-time home buyer, or you have to qualify with what's called a home possible or a home ready, which is if you're at 80% or lower of the area median income for the county that you're in, or that you're buying in.
Yep.
So, those are the ones that you'd have to look to see if you qualify for the 3% down versus doing the standard 5% down that is conventional loan.
And those are really some good benefits in those. A home ready, home one, home possible, and that definitely some good benefits in those. If you're able to qualify, as Joe said, as far as under the 80% AMI, then definitely some good benefits on those.
Well, and Joe, one thing we don't speak about enough is if you're at a 50% of the area median income and you're still buying a home, which you can still qualify, guys. It just depends on how your budget is and where you're at in your area. There's also some benefits to getting credit towards, like, a grant towards your down payment or towards your closing costs. And those are for any lender that you go to. When it comes to 50% or lower, it's just a way that it's trying to help people invest in themselves, because hopefully your income will go up over time, but there's ways that we can do that too. So I do like that they have those things on conventional, but conventional, one of the main positives versus FHA is, if you have 20% down payment, if you have the funds to put 20% down, you don't have any mortgage insurance.
Right.
And, and on FHA, Joe, if you're putting down 20%, how long is your mortgage insurance on there for that type of loan?
Yeah, you might as well just say lifetime.
No, that is not correct either. I'm sorry to prove you wrong.
12 years, right?
11 years. 11. If you're putting more than 5% down, it's on for 11 years, 5% or more. But if you're doing the 3.5, it is for the life of the loan. You are correct on that part. So,
Which,
but you know, I like conventional. I like conventional for the stronger credit qualifying. You know, if you're a 720 or plus, I'm looking at conventional first, depending on your down payment, depending on other factors of your debt to income ratio, because at that point we can get you a better loan that you can get that mortgage insurance off, and the monthly is probably going to be a little bit better than what an FHA, you know, just non-credit risk mortgage insurance is.
and a lot of times, I mean, if you're putting 20% down or more, it's probably because you're not a first time home buyer, but you're more of a move up buyer, right? Because you have that kind of equity in your current home to be able to put 20% down on the next home. I think I'd have to look up the statistics, Joe. It's as far as the number of first time home buyers that are able to put 20% down or more, right?
I would say that's probably a lower percentage than we all think. The other thing about conventional that, you know, the reason that we look at both depending on credit is on FHA, you have some risk factors that are inputted in there based on the investor and things like that. But when it comes to conventionals, you have what's called loan level price adjusters. And anybody can look it up. You can go to Google, you can say Fannie Mae loan level price adjusters, or LLPAs is what we call it in the industry. And it'll give you a grid. It'll say by FICO score on one spot, and it'll say by loan to value on another spot. And, you know, if you have a lower FICO score and you're at a higher loan to value, you're going to have a bigger adjuster that's going to cost the pricing for that interest rate to be higher. So then that way, that's why you have a higher interest rate on conventional than when you would with an FHA at that point. Kind of going to the side-by-side comparison, I guess, because, you know, those are the things that we do as professionals. We look at all of that together. And sometimes, Joe, I don't know if you've ran into this. When I'm doing a conventional deal, I might talk you out of putting 20% down and doing like 15% down, because the loan level price adjusters make it for better pricing, a little bit better interest rate, and the mortgage insurance is like $15 to $20 a month in that scenario. I might talk to you about that because that mortgage insurance is still a tax write-off for you. And once you pay it down under 78% or 79% loan to value, you can get that mortgage insurance off of there.
Right. I totally agree with you. I've even taken people to where it's like a 19% down payment, right? Or 19.5% down payment, because the interest rate, or at least the points on the interest rate, was cheaper than at a full 20% down. And they'd only have the PMI on there for 6 to 12 months, right? Which was probably going to be low PMI. So it was a better position to put them in that, to have PMI for 6 to 12 months, better interest rate, lower cost on the points of the interest rate. But you got to weigh them out, right? Yeah. I mean, that's, and when you're working with a true professional like Joe or I, you're going to see those comparisons. And that's a big thing with this. Even though we're comparing the two, FHA and conventional, it's good to be able to, when you're looking at, you know, pre-approving someone, when you're getting pre-approved, to be able to have that loan officer go through that with you, showing you both options, what is going to be a best fit for you, instead of just, you know, pigeonhole you into just one option.
Yeah. So Joe, I'm gonna ask you a different question. When you are pulling somebody's credit, do you already in your mind know which way you're going to present that loan, if it's going to be an FHA or a conventional, just based off of credit score?
No. I mean, well,
you're right.
If I got an 800 credit score, well, yeah, I'm going to do conventional, you know, but I mean, you know, if I get a credit score of, you know, 592, then I know I'm going to have to go FHA, right?
Yeah.
But if you're talking something, you know, in between there, no, I don't. Not until I put everything together, which is another reason, folks, why I'll just interject this real quick. You know, when people ask those questions that we said earlier, as far as, well, should I get an FHA or conventional? I don't know until we put everything together, right?
Yeah.
Let's bring all the numbers in together. Well, what's my interest rate going to be? I don't know until we bring everything, you know, together. and that's one thing I really want people to understand. This isn't like a drive-through at McDonald's. Okay. I mean, seriously, when
not order takers, is that what you're saying, Joe?
Exactly. Okay. We're not, you have to be able to bring all the numbers in because there's so many different factors that go into what is the best fit for you. Right. Because listen, whoever you're, watching this with or sitting next to at work or whatever, I guarantee their tax return is different than yours. Just like qualifying for a mortgage is going to be different than yours. Right.
Joe, I love how you said it the way you did. If you are working with somebody that's you're talking to and you're like, hey, I have a 700 credit score, and they're like, oh, great, we're going to put you straight into a conventional. They're not doing the right thing by what Joe said there. One of the biggest parts is let's get all the data together before I'm going to make you any kind of suggestion, because if I just make you a blanket suggestion, then I'm not a professional. So I've been doing this for 25 years, and I still have to look at all of the factors before I'm going to try to give you a recommendation on my personal or my professional opinion. So I love how you said that, Joe, because you're right. It doesn't only matter on credit score. It matters down payment. It matters what other assets do you have? Where can we tap in? Both of these loans also, and this is one of the big comparisons, is down payment.
Yes.
Right. We talked about the 3.5. We talked about the 3 and the 5. Joe, quick question. Does all of this money have to be yours for a down payment?
Oh, great question. Great question. No, you can actually use a gift of funds.
Okay. Are there stipulations on who can give you that gift for each of these loans that might be different from one or the other?
Oh man, now you're digging deep, dude. FHA is stricter, right? They want it to be immediate family, right? Conventional, I think, is a little bit more flexible. Am I correct on that?
A little bit, yes.
Guidelines better than me, but
yeah. So when it comes to FHA, they want family members or a close friend with financial impact. This is kind of what FHA states on there. The thing that I would tell you there is we used to be able to say their cousins and things like that. FHA did away with that part. So that's what you're talking about, Joe, more immediate family, aunts, uncles. They also put in there now fiancés can, be gifters, things like that. So, that is one of the things. Now, conventional, it is family. It just says relative. So you can't have a close friend when it comes to conventional to give you a gift of funds. So that's one of the things that I want to talk about. And then, the differences between the gift of equity is similar. You still have to be a family member to be able to do either one of those. So I just wanted, everybody thinks I have to have this money saved. I have to have this money saved. Well, if your parents or your grandparents are like, hey, you graduated college, we're going to help you out, with some money to buy a house, that is acceptable source of down payment for your loan. So, the reason I bring that up is because there are slight differences between the two. So that also goes into our recommendations. Going back to what Joe was saying, I have to have all the information before I can make a suggestion. Because if you're getting a gift from a friend, and I can get documentation to show how close and there's a financial well-being there, then we could go, but we can only go FHA on that. I can't go conventional. So again, if you make a blanket statement, you're working with the wrong person. Call Joe or I, shoot us an email, do that way, so that way we can help you with the right information.
Because you're right. There's so many different factors that go into this, and especially in looking at your goals, right, is going to be another factor as far as what direction we are going to lean more towards, right? How many years are you going to be in this home? How long do you figure you're going to be in this home, right? If you got transferred from work, you're moving into town, you're going to be here for 2 years and then move, to the next state, so to speak. These are all different factors that go into it.
Yep.
So just keep in mind, we're not a drive-through McDonald's.
And the one thing is with conventional versus FHA. And Joe, I don't know if I know the answer on this, and if anybody's watching or knows it, please let us know. So one of the things we've talked about in the past is called a recast, where if you're selling a house and then you're buying a new, doing a lower down payment, which one will allow a recast? And I know conventional will allow recast. I don't know for a fact if FHA will. So that's another thing that I take into account when I'm trying to qualify, because just because you're selling the house doesn't mean that your credit's perfect. You might be downsizing, you might be selling to use some of the equity to pay off debt. So we might put you in an FHA, but if you're trying to pay down more, then I'm going to make sure I understand, can I do a recast on FHA? Because I know I can on conventional. You cannot on VA. So I didn't think you could on FHA. Thanks for looking it up, Joe. So that's another one that we want to know the information before we make a blanket recommendation.
Yep. So all these different factors, as you can tell, folks, I mean, there's over 20 different factors that go into all of this. So, when you reach out to a professional loan officer like Joe and I, and you say, okay, here's my credit score, what's my interest rate going to be? I'm sorry, but I will tell you somewhere between 5% and 8%. How's that? Yep. Right? I mean, and somewhere in between, because we just need more information to be able to, and the more information you give us, the more finite we'll be able to get that, decision made for you. Right. Yep. So,
yeah. Well, I put up our email addresses, guys. Please, email Joe or I. You can see both of them right there. It doesn't matter who you contact one of us if you have any other questions when it comes to FHA versus conventional. We would love to help you. And if you even live outside of the states that we've talked about in the past, any state you live in, if you're watching this, we don't mind giving you answers, helping out a loan originator if they need it. We have 50 loan originators just in our branch that are licensed in multiple states throughout. And then we have U Mortgage, which is our parent company and the best loan originators in the industry. I'm going to say that it's on record, it's recorded. We will find somebody that can be a trusted person in your state to help you. I think there's one state we're not licensed in. Don't ask me which one that is, but I think it's New York. I can't remember exactly,
or something like that. Rhode Island,
somewhere. But we'll find somebody that can help you out for sure.
Absolutely. Let's just kind of recap some things here before we wrap things up. So keep in mind, FHA is not just for first-time home buyers. Anyone can use it. I know we didn't specifically cover that, but understand anyone can use it. Even if the current home that you're selling has a conventional loan and you're looking to buy a new home, the next home moving up, so to speak, you can use an FHA loan for that. Conventional doesn't always mean harder to qualify, right? PMI isn't always bad. It's actually a stepping stone to homeownership. So even though you're not putting 20% down, that's okay. 3.5% will get you in and start building equity and start building your wealth with home ownership. So make sure you talk to a lender early to be able to compare both sides, FHA, conventional. Final takeaway I want to give here, talk to your lender early to compare both sides. There's no one size fits all, folks. The best loan is really the one that fits your situation and your goal. So
I have one more takeaway, Joe.
Please.
If you are going with an FHA loan, make sure your lender is comfortable enough calling listing agents, because your buyer's agent might be like, well, this one might not go FHA, or they might not accept an FHA. We do this all the time. We call the listing agents. We discuss the property. We discuss why we're going FHA, not giving them your credit information, not giving them your income information, but because it's a better loan for your situation. And listing agents understand that. So we get all that knocked out before they accept a contract a lot of times. So that's one big takeaway.
Well, thank you everyone for tuning in this week. Next week, be sure to tune in at our usual time, Wednesday, 9 a.m. Central, as we are going to dive into the differences between refinancing as far as taking cash out refinance or just changing your rate and term, and which one is the right fit for you. So Again, thank you to everyone that tuned in. Sorry we didn't get any comments, questions, or anything. But still, if you're watching this, feel free to drop them in because we will definitely answer them even after the show. So feel free to drop any comments or questions in. If you want to catch up on some of the past episodes, feel free to go to our YouTube channel at the Mojo Show Real Estate Podcast. And while you're there, be sure to hit the subscribe button because we are on a mission to get to 1,000 subscribers. And every like, share, and comment, it helps us really reach more homeowners like yourselves. So before we close things out, Joe, any last words or nuggets of advice for our listeners?
Just thank you guys for supporting us. And like Joe said, questions are really things that we want to answer. So ask them and ask them often.
Well, I am Joe Mortgage, and that handsome guy with the beard is Cup of Joe Mortgage, and we'll see you next week.
Mr.